chart on your screen shows that on 17th April, Nifty 50 touched the levels of 23,900, where in just 10 days ago, that is 7th April, Nifty 50 touched the levels of 21,800. That means just within 10 days, Nifty 50 rallied almost 2,100 points. Now, the bigger question is, how sustainable is this rally? What future holds in or the stock market investors? So in today's video, we would be understanding first the reason for the fall in Indian stock markets, then the reason behind this rally, and then most important question, how sustainable is this rally and what should be your strategy so that whatever future holds for stock market, but you should be in a win-win situation. Also, we would be analyzing the sectors which should be your focus for future and for planning your investments. So to get the answers and analysis for all these things, please watch the video from starting till end. But before that, don't forget to subscribe the channel by subscribing the subscribe and bell button below. Also, if you have any kind of queries, you can definitely reach out to us on the mobile number 9821611667, or you can write to us on investopediaindia0@gmail.com. And also, if you like the video, if you have any kind of questions, if you have any kind of suggestions, please don't hesitate to pause the video and comment down below in the comment section. So now let's get started with the video. First of all, let's understand what was the reason behind this massive fall in the stock markets. So this definitely most of you must be knowing that there is a trade war resulting due to the tariff war mainly going on in between US and China, as Trump implied tariffs which were not justified and were considered too high, and because of this then China retaliated with heavy taxes, heavy tariffs. They said that we won't be doing trades with US and things like that, and this led to a trade war which resulted in market falls. Now, if this trade war is going on, then what was the reason behind this rally that in 10 days 2100 points rally was shown by Nifty 50, which is quite a significant rally. So this rally was there because Trump said that he is putting on a hold on the tariffs which he has applied, and there is a discussion which is going on in between US and China to come on a mutually agreeable trade terms. So basically, if they come on a mutually agreeable terms and the trade war is come to a halt, the rally is going to sustain. But clearly, if at any point there is a disagreement in between both the countries, or any tariffs are imposed which are not agreeable, this might again lead to disturbances in the stock market, in the tariffs, in the global economic scenario. So definitely this rally is not very sustainable, and we cannot say that there would not be any falls going forward. So what should be your strategy is the bigger question. Now, two things you should understand before investing in equity markets, whether through mutual funds or directly, is over a period of time, one thing that has been regular and consistent in equity markets is the irregularity or volatility. Bears and bulls both are part of equity market and cannot be separated. So there would be falls in the market, there would be runs in the market. Second, if you are prepared in terms of courage and in terms of capital, then every fall throws huge investment opportunities for you. So, but definitely to benefit out of that, you should have the courage and you should have the capital. So now let's plan and understand that as an Indian investor or as an investor in Indian equity market, what should be your strategy? So see, India is not directly involved in this tariff war or trade war, but because in today's terms of globalization, spillover effects would be experienced by Indian markets, Indian industries and Indian equity market as well. So if we want to analyze that what should be our strategy to be in a win-win situation, now first of all let's understand why this trade war is so scary, or why it might lead to strong disturbances in the equity market due to spillover effect also. So have you ever heard about the Great Depression or the Black Thursday? The situation right now is very similar to the Great Depression if this tariff war is not controlled immediately. Why? Let me tell you. So the Great Depression is the longest recession faced by globe across all the economies, which started in 1929 and lasted till 1939. It started in US and the major impact was felt in US. So in 1929, US stock market on Thursday 24th October, as soon as the market opened, there was strong selling. Only sellers were there in the market and market fell by 11%. Now obviously there were measures which were taken to control this, but all failed, and on Black Monday, that is 28th October, again market fell by 12%, followed by Black Tuesday, that is 29th October, wherein market fell by 11%. So this definitely led to a strong negative sentiment, huge sell-off, market crashed badly. There were lot many implications, industrial impact, loss of jobs, and a lot many things. Now, since US economy was in a bad shape in 1930, US implemented Smoot-Hawley Act in 1930 majorly to safeguard their agricultural interest, looking at the 1929 fall in the stock market. Now, because of the pressure from industrial lobby, this tariff, which was initiated just to protect agricultural interest, was levied on across 20,000 products, and the tariffs which were levied were as high as 100%, starting from 40% till 100%. So obviously now, because US implemented this kind of tariffs, all other countries retaliated. Canada, Germany, UK, everyone retaliated, and at that point of time, the US exports shrank by 61% and overall global trade reduced to almost 60%. Two graphs on your screen clearly shows what was the scenario of global trade at that point of time. Because of this, then this had a lot many effects. It led to actually a ripple effect across the globe, across all the countries started losing job. Why? Because import export were totally restricted. There was no money. The industrial people also, the raw material is coming expensive. The labor is becoming expensive. They want to shrink, they want to reduce their cost. So people were losing jobs. There was no money overall in the countries, in the economies, and therefore one after other, all the economic systems, all the economies of the world failed, and therefore this recession lasted for long 10 to 11 years. Not only this, there are many more examples wherein this protectionist economy led to failure. Argentina, Brazil, and let's not go too far. Let's look at the Indian economy. If you recall, till 1991 in India, people used to study. They were having good degrees, but they didn't used to get good jobs. It was only after 1992 globalization, liberalization in India, that people used to get good jobs in MNCs, used to get good packages, and the spending power of the common people increased in India. Once the spending power of middle class increased, the economy ramped up very fast because people started traveling to by flights rather than trains. People started, domestic tourism started. People started expanding on everything. Malls came into picture. People started using brands. So overall, the economy revamped. Therefore, is very important. And if we look at the past and if we look at the present time is the most advanced time wherein all the economies, all the trades are interrelated. So any kind of trade war, tariff war, or restricting trade with any of the countries would have adverse effects globally as well as on individual economies. So now let's understand Indian economy, Indian stock market, and Indian industries in depth to formulate our strategy if this trade war continues. If we look at Indian industries, current scenario, one thing is very positive. The balance sheets of the company is far healthy as compared to previous times. So on your screen there is a chart from 2003 till 2024. we have taken sectoral data is there. We have taken median debt to asset percentage across the sectors. So you can very well see that all the companies in across all the industries have drastically reduced their debts. So now they are in a situation wherein if a slowdown comes, they would be able to sustain, they would be able to raise money or capital to survive further and to sail through these difficult times, which is a very strong point in Indian companies at this point of time. But however, right now I am using the term Indian companies. That does not mean that all the companies are cross. When you are investing in direct equity, individual company, their financials matters. You have to study that. This we are talking on a larger picture. We are taking broadly the companies, and then we have taken the data sectorally. We have bifurcated that, and we have come on these numbers. Should you expect a huge return on your investment when you are investing in Indian companies? So see, right now this situation of trade war or tariff war has come. Even if it was not there, we have seen a strong multi-year bull run. So now the companies are expected to show a muted growth. A huge rally or huge returns cannot be expected from the companies. So if we talk about the returns or earnings of a company, majorly depends, their profitability majorly depends on three factors. Their sales should increase. Second, the margin expansion should be there. And third, their how much amount they are investing further for their growth. Right now the thing which is under pressure is the margin expansion. Already a lot margin expansion has been done, a lot of growth has been shown by the companies. So now growth would be muted, it won't be like exponential. And also because of the global pressure or global recession, so many tensions going on globally, the situation would be under stress. Sector wise data is there on your screen from 2008 till 2024. Now the third chart on your screen shows sectoral market cap in last 5 years CAGR percentage from 2008 till 2025. So how the companies have shown a strong growth. Now market cap, the growth, the returns on investments have been quite significant in last years, and therefore from here on when we are investing, it is very important to do value investing. While doing value investing, it is very important we identify the right sectors and then the right companies, and we invest at right time. Also, it has to be aligned with our financial goals, that what is our focus, why we want to invest. It is a short term goal, it is a medium term goal, it is a long term goal, how long we are ready to be invested. And if market corrects, if there is any correction, if market goes down, are we able to infuse more funds, or do we requiring those funds even if market would be correcting? All these questions need to be answered before you put in your funds. Now coming on to the last chart, which is again very important. This chart shows that if we take out the percentage of stock trading below their 30th percentile as per their historical valuations, which are the sectors which are throwing the most lucrative opportunities or are available for value investing at this particular point of time. So the first two sectors are private banks and finance industry. Now finance industry, financial services, what does that suggest? The companies who are offering insurance, the companies who are offering housing finance. So the three top sectors which you can focus right now to invest, which are offering lucrative value investing opportunities, are private banks, housing finance companies, which includes NBFCs offering housing finance, and insurance companies. PSU banks, because historically if we look at their high point and low point, so if we take their last 5-year data, PSU banks have shown a huge rally. From here on, if we talk about charts and data, it shows that it is overvalued, but still I feel PSU banks also might show a good growth. However, private banks are available at quite lower valuations as compared to PSU banks at this point of time. Now, besides banks and financial services, there are other sectors also. If you can see, oil and gas, chemical, auto, metal, healthcare, you have to be selective while picking the stocks. And then FMCG, capital good, Okay. IT, I would suggest at this point of time you might avoid. I hope this video makes some sense to you, give you some understanding about the markets. If yes, please do comment and tell me. And if you still have questions which you want to be clarified, please do comment and ask those questions. I hope you like the video. If so, please do like and subscribe the channel and share the video. Thank you so much.